I don't think anybody's talking about raising the capital requirements now. I think everyone's saying in the longer run, after this crisis has passed, we clearly have to raise capital requirements across the board so that banks have a greater cushion against the kinds of losses that we've just seen. Secondly, capital is going to be increased disproportionately for larger institutions because we want to try to attack the too big to fail problem that has bedeviled us in this crisis. But in the short run, there's no real way that we can raise capital standards without harming the recovery, which is why it's not going to happen. The more problematic thing actually is that even with the existing capital requirements, banks are afraid to lend because they're nervous that there are more losses coming, especially in commercial real estate, and as they take losses on their balance sheet, that impairs their capital and puts them closer to the edge where regulators get nervous. So even under the current regime, I think there's a reluctance on the part of banks to lend because they don't know how much additional loss they're going to have to take. Banks, frankly, need to earn money to refill the coffers so they get back up to the point where they can feel comfortable lending again. And so making money is not a crime. It's part of the recovery process. And in fact, the so-called upward sloping yield curve that we have right now, which has been engineered by the Fed, the very low short-term interest rates coupled with actually low but higher long-term interest rates, that margin, which is roughly 3 percentage points, is what has allowed banks to make money. And they're going to need that margin for some period of time to repair their balance sheets.